What are the most debated financial topics? I found an article online and we will use that as inspiration to go over some of the most debated financial topics out there, like rent versus buying, paying off debt versus investing, a credit card or no, term versus permanent life insurance, ETFs versus mutual funds, emergency fund versus paying off your credit card debt, or maybe even a 15-year mortgage versus a 30-year mortgage. So we'll cover these hotly debated financial topics on this episode of Through the Pines. So welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while running sea trials on his new yacht. This is Through the Pines. Our advisors for this episode, we welcome back Rex.m.baxter and Brandyn Smith in studio with us here in the trailer. Rex, he's in his office, right? That's where he's always at, in the office. Never leaves. He's always there.
24/7.
24/7. They are the 2023 and 2024 Forbes Best in State Wealth Management Teams for Utah, as well as the Advisor Hub Fastest Growing Advisors to Watch Under $1 billion, and the receivers of the Ameriprise Client Experience Award. So they know what they're talking about. Welcome back to the podcast, Rex and Brandyn. I'm excited about this one because, I mean, I'm hoping to just drive division between you two.
I like it.
I'll do my best.
Okay, good. So we'll jump right in, and I will say I did find this, and I'll link the link to the original article in the show notes. But it is thomaskopelman.com, the most debated personal finance topics and his opinions on each. But these will be our opinions. But I want to do give credit to Thomas for coming up with like these top topics here, and then we'll sort of give our own opinions on those. But the link is in the description, so you can visit that and see what his thoughts on the subject are as well. So we'll start with rent versus buying. Rex, when should we rent versus when should we buy? And this is an interesting,
Brandyn.
And it depends on year too. It depends on a few things, right?
Yeah. Thanks for having us. This may not come across great on a podcast, but I have an idea, and It might be a really bad idea. And I probably should have cleared this with you before we jumped on the podcast. But what if we do just rapid fire on all 7 of these? Brandyn and I have to answer at the same time, and then we go back and discuss each one.
Okay, no, I can do that. I think it's a good idea. I like
what do you think?
Things up on the fly. So I'm going to put Brandyn on screen here. So we got Rex and Brandyn on screen, but the first one is kind of hard. So you guys you can't answer at the same time, can you?
Oh, sure.
Okay.
Sure,
okay.
We can.
Okay, 1, 2. Okay, I'll say rent versus buy, or 1, 2, 3. Rent versus buy. Go.
Depends on time frame.
Buy.
Okay, next.
Depends.
Okay.
Not buy. Hang on. Don't buy it depends diapers. Just buy it depends. There we go.
Okay. Next one is pay off debt or invest.
Depends.
Invest.
Invest.
Wow, I'm gonna win all.
Matt, quit with the depends. Take a position.
I know, Rex. It does depend.
All of these depend.
I look forward to winning each of these debates so far.
Okay.
All of these depend. I'll give you that.
Credit card versus not.
Credit card,
not.
As long as it's paid off every month.
Rex, what was yours?
Mine was not.
Oh man, this is going to be Brandyn's podcast. I'm going to send this to all my friends.
Ready? Term versus permanent life insurance.
Term.
Oh, okay. We agree. ETFs versus mutual funds.
ETFs.
Depends.
Emergency fund versus paying off credit card debt.
Emergency fund first.
Agree.
It depends.
15 versus 30-year mortgage.
30.
Oh, that one surprises me. Okay, I thought you guys would say. I thought all.
I mean, each of those have.
They all depend.
They all have a caveat.
They all have caveats.
And that's why these are the most debated financial topics, because it depends on your situation on all of these. And when you talk to different financial advisors, they'll give you different reasons for each. So let's get into the first one. Rex.
I don't think they're that controversial, though. I think
you guys disagreed on.
Yeah, I know.
We disagreed on all of them, but for very succinct reasons, right? And so as we go through these, you'll see why I say I don't think it's very controversial.
Okay, rent versus buy, Rex. Go for it. What's your reasoning?
So I said buy, but it does depend on the time frame, right? The other day I was talking to somebody that was one of our clients that's in the military. They just moved up to Virginia, and they're going to be stationed there for 2 years until he gets reassigned to a new post somewhere else in the nation. In that situation where he's only going to be there for 2 years, it's probably better for him to rent for those 2 years, because one, you have the closing costs on top of that, assuming he's taking out a mortgage, you would have the closing costs. You may have additional, depending on the age of the house, you may have additional repairs, upkeep, maintenance, things like that you want to do that typically would fall on the owner of the house as opposed to you if you're renting it. And so it depends on your time frame. And so I like to use a 5-year time frame or longer to when I'm buying, and 3 to 5 years is questionable. Less than 3 years I like to rent.
Okay, wait, but there's a caveat to that as well, because what if the person stationed there, that's like their dream place and they want to retire there, but they could buy a house, rent it, finish out moving all over wherever they go, and then they got a house with, you know what I mean? Like, so everything depends.
Yeah, so it depends if they're in a financial position to where they can keep that house, rent it out when they're restationed, and still buy a house somewhere where they're permanently stationed, then I understand that. But if they're not in a financial position where they can keep that house as a rental and still afford another house, then I would say same rules apply, that we're not going to buy the house there where they're there for 2 years. Even if we're going to come back to that location, we're going to use the equity that we build in the other locations to come back and rebuy in that original location.
Okay, Brandon?
Yeah, I'd say buy with the 2 major caveats of financially ready, like Rex said, right? Because we don't do things unless it makes sense financially. Like if you can't afford the house, I don't care if it's not, like you don't want to get yourself in a position where you're so house poor that you're on the verge of bankruptcy or end up in bankruptcy, because that just puts us back further. So we want to make sure that we're financially prepared for any purchase, especially major purchase that we make. And then secondly, Rex mentioned that 5-year time frame, and I'd agree, right? Not only are there the costs associated with getting a mortgage, the costs associated with, paying a realtor, whatever. I mean, there's a lot of different costs involved in buying a house to make that break even during a normal time frame. But sometimes the housing market goes south, right? Sometimes you can buy a house and it'll be worth less 2 years later. And so anytime you buy a house, you also should kind of double check that with yourself and say, if I get stuck here for 5 years because something crazy happens in the economy or housing market, am I okay with that? Am I going to be able to work through that? Or would I be able to take a financial hit big enough to get out of that? And so I think those are my 2 caveats. Can you afford it? And then time frame.
Rex, what about if it's ever cheaper to rent and invest the difference, and you try to run the numbers on that? Or is there no way to keep up with how houses housing going up? You know what I mean? Like, what are your thoughts on that?
Yeah, I think that's a difficult calculation, just because, I mean, you can't say, okay, I'm renting for $2,000 a month, and if I I'm buying at $2,500, but maybe that $500 is going towards principal of the house. Mm-hmm. And so you may say, well, what if I invest the $500 a month? It's hard to know what the rate of return is on the housing. I know a lot of people use, somewhere between a 4 to 5% long-term rate of return of appreciation on real estate. And I've seen a number of different averages out there. Typically, I don't consider my primary residence as necessarily an investment, because I'm living there, and I'm not going to time my selling of that primary residence just because of the market that's out there. If it's a rental property, that's a different animal. But my primary residence is, I'm buying it for ownership, for long-term family stability. I do want to make money off of that over time, but it's not as transactional as a rent versus buy, invest the difference calculation might assume.
Yeah. Okay. That makes sense. All right. Pay off debt versus invest. This is probably a big depends. Rex, you want to start on this one?
I'd agree.
It's a
big
depends.
Big depends. Big. Yeah. I need a graphic of just depends underwear on this whole show. But yeah.
We do. We just pop it up there. it's going to come down to interest rate, right?
Okay.
Is if you're paying, if you have a loan at 19%, then versus investing, I'm going to pay down that loan, right? I'm going to focus on that before I focus on investing. Where it starts to get into the gray area for me a little bit is if you're paying, 5 or 6% on debt, then it starts to a little bit of a gray area to where that's a little middle ground to where I may, depending upon how aggressive or conservative you are, might sway me, and your time frames might sway me one direction or the other, is in addition to maybe your personal habits, as far as whether you're diligent about paying that down or whether it gets paid down during the year and then racked back up during the holidays. And so there's a bunch of behavioral issues that would kind of sway me one direction or the other in that interest rate. If you're, you have a car loan at 2%, or a home loan you refinanced a couple of years ago at 2.5%, then I'm probably going to focus more on the investing and just make the minimum payments, because that's a fairly low interest rate. And so it is a big depends across that spectrum for me.
So that is not the Dave Ramsey way. So, and that's,
Was he our standard?
Yeah.
I didn't know he was our standard.
So, is that, why does he do it that way? Is that why there's a debate? Because he's so popular in with his show and things, and he suggests, no, number one, pay off debt. And then then you talk to another financial advisor, and the financial advisor says, it depends. So is that why there's so much debate over this?
I think you talk. No. Oh, go ahead, Rex.
He just has to speak to the masses, right? And so he has to make a big generalization that is more applicable to the majority of individuals as opposed to the minority of individuals. And the majority of individuals are not great with money and have poor money habits, have poor saving habits, and utilize a lot of debt, and don't understand, compounding interest working against them, and being, I think he says, a slave to the debtor or something like that. I can't remember exactly what his term is, but I think that's why he says that. And I don't fully agree with that. I think that there's lots of people and lots of individuals that don't fall into that category. And that's why it's a big depends for most financial advisors, including us, is because it depends on your situation. So it's not a hard rule, and yet he states it as a hard and fast rule. And yet I think if you looked at, if you pushed him into a corner and said, look, do you want to pay 2% on this mortgage, or do you want to invest it in 4 good growth mutual funds, as he states? My guess is that he would lean towards making the minimum payment on the 2% and investing the difference in those 4 good growth mutual funds.
And Brandon?
Yeah, I think there's a component to it, feeling good to pay off debt. And I see it all the time with clients.
Yeah, we didn't talk about that part. That's another thing too.
Yeah, it just feels good, right? And in fact, I was having this conversation the other day with someone who had a home mortgage at it was 2.5%, right? It was like nothing. And it was I can't remember the exact numbers, but call it $100,000 that they owed on their house, like just a small balance kind of at the end. And they had over $100,000 sitting available in cash, right? Easy to pay that off. And he was like, I'm just going to pay this off. Is that crazy? And I said, well, not necessarily, right? It might feel good to pay off the debt. However, if you're open to it, right, we could go buy a CD, an FDIC insured guaranteed CD at 5%, and on that 100,000, take the spread, right? And we would make $5,000 a year. Of course, we'd pay $2,500 in interest, but you take the spread of $2,500, right? And my question to him was, is that worth it, right? Does it feel good? Does it feel $2,500 a year good to pay off debt? And if the answer is yes, like I don't need $2,500, like I just want to be able to say I'm debt free, then yeah, pay off the house. But if the answer is, you know what, $2,500, I could go on a vacation or get part of a vacation paid for that. It's a guaranteed, right? The insurance or the mortgage company is not coming after me, right? I just have to make the minimum payments. It's a guaranteed FDIC insured on this side, right? Why wouldn't you run that? I mean, you're taking no risk, but someone's handing you $2,500 in interest. And so that's the depends.
Yeah. Yeah, it does depend. And I think when it comes to your house, Rex, it depends even more, right?
Yeah, for sure. It depends even more.
All right. Well, let's bump to the next one of credit card or not. I think you guys disagreed on that.
Yeah. Rex took not on this one.
Like in any circumstance, Rex. Never.
No, I mean, there's some individuals. There's a small, small subset
It's not as small as you
of
think.
individuals that are good at managing their money and their credit card debt and not carrying a balance and able to accumulate points and utilize the benefits of some of the cards and keep them paid off. Unfortunately, my experience is that it's a very small subset. And so that's why I say not as a general rule. But there are some exceptions. And so it does depend. But generally speaking, life happens to people and it happens fast. And more frequently than not, people end up with a maxed out card, and then it takes them 3 to 5 years to kind of drag through it and get it paid down. So,
okay. So Rex is no. Brandon, Brandon's taking all the flight miles, I think.
Yeah. No, not flight miles, but we do. My wife and I, we use a credit card.
Yeah.
And as we've said so many times on this podcast, make it automatic, right? Make sure. And so we just have that credit card pay off every month, the full balance. It just, and I always double check statements, make sure I'm not paying a penny in interest. But then it's just, and whether that payment comes out over the month of all the things we've purchased, or if it comes out at the end of the month, doesn't matter to me, right? It kind of makes our bank statement jump a little bit, but I guess I don't care, right? Because at the end of each year, I get a big check of cash from the credit card company we're using for just the points that we used.
Yeah.
And so, if I'm earning money and not losing it, and it effectively, we're not changing our spending habits at all. And I think that's the key, right? Is that I never at any point when I'm using my credit card, never do I feel like, ooh, this is, I won't have to pay this back for 6. Like I know that it's coming out of my bank at the end of the month. And I think if you can do that, then you can generate Sky Miles, cash back, all of these things. But to Rex's point, you have to know yourself. And if you're one of the people that runs up a massive balance that isn't going to be able to pay it off, I mean, the amount that you get back in Sky Miles usually doesn't even remotely cover the interest you've been paying.
And so neither one of you would pay. So if you used credit card, neither one of you would pay interest at any point. Okay.
Right.
Yeah.
Yeah. No, especially right now, interest on credit cards are like 22, 24%. I mean, it's an expensive. And what's sad and hard about it, right, is all the people who had a credit card debt at 10%, which wasn't a good idea, right? But then all of a sudden interest rates come up out of their control, and now all of a sudden the amount they're paying in interest doubles as the economy's kind of, that's not what you want.
Yeah.
So I was looking at one the other day, just really quick, with a client, and we were kind of going through their financial plan, and they showed me a balance of maybe 10 grand, and they're like, yeah, I think it's about 9.99. And so I said, well, let's just pull it up and let's look. And it was 34.99 at this point, meaning that on 10 grand, they're paying $3,500 a year of interest, just interest.
Just to hold the privilege of having credit card. I mean, that.
Yeah. That Rex. So then, okay, this isn't on there, but then at that point, do you find that money somewhere to pay it off? Like pull it out of your house or something? Like, how do you do that? Like, what do you?
Yeah, sometimes we have to take out a home equity line and lock that home equity line in at 6 or 7 or 8%, which is where they're at today. But a lot of times it comes down to behavior, to trying to change the behavior of that client, because too frequently they've done it once, therefore they'll do it twice and 3 times, and it's a recurring problem. And so it's as much about educating on the behavior that caused it and working through that as finding a way to cut down that interest from $3,500 a year down to $600 a year by refinancing it through a home equity line or something else.
Okay. Sounds good. Okay. So you guys agreed both on this one, term insurance versus permanent life insurance. Rex, why do you like term over permanent life insurance?
This one also depends. And so there are situations where permanent life insurance has a place and it has a role. But the vast majority of people just need term. And so the vast majority just need to cover the immediate risk and needs of them passing, or their spouse passing, or one of their kids passing, to get them through the mortgage period, the education period of kids, the child rearing period, on spouses, things like that, as we get through. But most of the time, once we get into retirement ages, most of the time there's not a need for life insurance. Generally, we've saved enough that if we lose a spouse, that financially we're prepared and we'll be okay through that. There are situations where we need some permanent life insurance, and it is the one product out there that has the unique ability to create money when money is needed most. And so if you have an extremely high net worth and we're needing to pay estate taxes or death taxes, and so this would be, your net worth might be over $25 million, and it might be 50, then we're going to have a big tax bill that's due within 9 months.
Yeah,
and so we may
should talk,
utilize.
Rex.
Yeah, a lot of people should be calling me about this.
Yeah,
So, I mean, these are the kinds of clients that we work with, and the kinds of problems that persist that we're having to deal with on occasions. And so those are situations. If it's something where we know that, we have a special needs child, and we know that we're going to need some additional capital to help them throughout their lives, regardless of when we pass away, then we may need permanent life insurance. So there are very specific situations where permanent makes sense.
Okay.
But the vast majority, we need term.
Okay. Brandon, did you work in the insurance industry?
Yeah.
Is that where you started?
First 3 years were at Northwestern Mutual.
Okay.
And
still does. Still works in the insurance.
Still technically worked in the insurance.
You're still licensed. Is that what that means?
Still fully licensed. And we help our clients with life insurance.
Yeah.
But it's almost always term, right? And to Rex's point, there are caveats to that. There are times when it makes sense. The majority of the time you can do it with term, and it's dramatically more efficient.
Okay.
Unfortunately, I can't tell you how many times I've seen an IUL, Indexed Universal Life, a VUL, Variable Universal Life, a whole life insurance, all these different permanent insurance products sold when it just didn't make sense. And it happens a lot, I think, because you get some people who are kind of holding themselves out as financial advisors, but they don't have securities licenses. So they can't actually do all of the financial advising stuff, but they can sell you a life insurance policy. And so by dang, they're going to make sure this life insurance policy also acts as a 401k or a retirement plan, right? Even if it's not the most efficient thing. And then the other thing is so
efficiency based on the fee structure of those?
Based on growth. Okay. A lot of them just don't grow very fast because there are a lot of fees and costs built inside of an insurance policy. Mm-hmm. Okay. And so you have that, and then it kills me. I wish it was just more disclosed, but the commissions paid on those are really, really high. And so you get a lot of people that kind of, I don't know, talk themselves into thinking permanent insurance is the best option when so often it's not.
Okay. All right. Well, ETFs versus mutual funds. Did you guys both say ETFs?
I said both.
You said
Rex
both?
said ETFs.
Yeah. Rex, what do you love about ETFs?
I like both, but ETFs typically are more efficient from a tax standpoint and a cost standpoint than most traditional mutual funds.
Okay. Sorry. We didn't define it, though. You want to just define the differences between ETFs and mutual funds real quick?
Yeah, so an ETF stands for exchange traded fund, which means essentially it's a basket of holdings of stocks, of bonds, or a blend, whatever the case may be. And inside of that, there are actively managed exchange trade funds where somebody's buying and selling, and then there's passive exchange trade funds where it's mirroring an index like the S&P 500 or the Russell 2000 or some of these different stock market indexes out there. But it trades throughout the day on an exchange, just like an individual stock does. So just like a Microsoft or a Home Depot or a Costco or any of these companies. It trades throughout the day, and so you can buy and sell if you're needing to do things. Where a mutual fund trades at the end of the day, and essentially what's happening is if you sell your mutual fund, the mutual fund's having to keep a certain amount of cash in order to cash you out of that investment. And so mutual funds are having to maintain a certain amount of cash. And then they're also having to distribute on an annual basis their proceeds, the capital gains proceeds from that trading activity. Now, exchange traded funds, if they're actively managed, have to do that as well. If they're passively and they're indexed, then typically there's very little activity inside of that. So there's very little to distribute out of. But because of that lack of trading activity, exchange trade funds frequently have lower costs, not always, so you have to be careful. But typically they also have a lower tax impact for you as well.
Well, I learned something today. I didn't know that. Brandon, what do you like about ETFs and mutual funds?
Yeah, I think they're both good financial tools, and understanding the trade-offs of what are you paying for, what are the components of that. And that's why I love like our accounts that we work with clients is most of our accounts have both ETFs and mutual funds in them. And we get paid based on the assets, and so we're incentivized to grow the portfolio, and it doesn't like we're not trying to push one or the other, right? We're trying to help clients understand what those are. And as Rex and I look and analyze those, we're just trying to find the most efficient rate of return possible. And so sometimes it makes sense to include a mutual fund. Other times it makes sense to just go with an ETF. And so we definitely use both of those. But I think Rex and I both kind of lean into ETFs a little bit more. And that comes, I remember before I joined Rex, I was talking to Rex. It's like, I don't know, Rex. Like, I don't know about some of these mutual funds. He's like, yeah, I don't know either. That's why we go with it, but we do have some mutual funds in our portfolio that have just done phenomenal, and so we hang on to those. But yeah, we both kind of lean a little bit more towards ETFs.
Okay. Well, I think it's time for some SMORE numbers.
Yeah, it is.
Yeah,
all right.
And this one is a good one. I've been told. Okay.
It is. So not to put you both on the spot, but do you know, so you've heard of blue chip stocks.
Okay.
Right. And blue chip stocks refer to kind of dividend paying stocks, well-established stocks. Right. So like a Coca-Cola or, some of these bigger name, well-established, cash flow is really built in. Do you know where the term blue chip came from?
I do not. Rex, do you know?
I'm not sure I do either. I mean, I thought it came
idea.
back when the Dow was created,
Hey.
and that they were essentially just good. So I thought it was just a term, like a term of endearment almost, that they're just good, solid, and blue chip at the time kind of meant blue collar, that they're reliable and steady and things like that. But
I was thinking like poker chip, like a
ding ding ding. Huh? So you guys nailed it together.
Yeah. Okay.
So go team. High five.
Yeah.
High five.
So the term was used by Oliver Gingold.
Nailed it.
An employee of Dow Jones, Rex, that described stocks that traded at $200 per share or more. And it related to the blue, white, and red poker chips that have like the greater values, right? Like the more like bigger stocks. So anyway, we use blue chip all the time, but I was like, what does that mean? So I looked it up and found that on Investopedia and actually a couple other sites. And so yeah, blue chip coming from poker, from a guy that used to work for the Dow Jones back in 1923.
Which is interesting because, I mean, those are probably not the most volatile stocks. And,
Yeah, known for being, I mean, they're still stocks, right? So they still move around. But yeah, a lot less volatile, right? When the market goes down, are people wondering if people are still going to drink, have their Diet Pepsi or Diet Coke? Right?
Yeah.
No, of course not, right? Like, in fact, we might drink more.
Yeah.
And so...
you're not gambling a whole lot is what I'm trying to say if you're putting all your money in blue chips.
Yeah, but there's that risk return feature as well. That's right?
True.
That if you buy a well-established stock, people kind of recognize that, so they bought it up so that the cost is higher relative to the earnings. And so everything, it doesn't make it right or wrong, but everything kind of has a risk return paradigm in the investing world.
Okay, so this is not on the list, but this reminds me of dividends versus not. And when do you do that, Brandon?
Both. We use both, right?
Okay.
And it's nice to have both because there's different market cycles, and you can get that diversity not only within different companies but different sectors of the economy. And it's nice to have sectors that will do better when others are doing poorly, but also have these that do poorly that also can just take off and run in good times. And so it's a balance, and understanding where your portfolio is and how much you have, because I see all the time people that they like get just married to the idea of a blue chip portfolio, and they go all in on blue chips, and then they wonder why their portfolio doesn't keep up, right? Because, well, you're not taking as much risk, right? And it depends on the time frame. Sometimes they do better, right? But really, you need to understand what risk am I taking, and why have I built my portfolio the way it's built.
We got two more left on the most debated financial topics here, and this one, I don't know, did we kind of cover this already? Because it's sort of emergency fund versus pay off a credit card, Rex.
Yeah, so I think you should always have some emergency fund money. The question is, do you have the full 3 to 6 months emergency fund established before you start paying down credit card debt, or do you have 1 or 2 months? Where's that fine line? And that, for me, again, will come down to behavioral finance. It'll come down to the individual and what their habits are and what the risk is, and how steady is their job, those kinds of things, because we don't want to only have a small amount in the emergency fund and they're in a very transitory type of industry to where they may come and go in and out of jobs, and every time they do, they just rack back up the credit card debt. And so the more risky their job is as far as them remaining employed, then the more I end up leaning towards the emergency fund and building that up so it's strong and steady, and then focusing on the debt. The steadier the job is, then I don't mind moving that and making that a little bit leaner to where we may only have 1 month or 2 months for a period of time while we're really focusing on that higher credit card debt. Because again, normally you're paying 10, 20, 30% on the credit card debt, and you're only making 3, 4, 5% on the emergency fund money. And so simple math at my college taught me that, I would rather, pay down 35% than earn 3% in math. And so anyway.
Okay, Brandon.
Yeah, there's something empowering about having money to draw on. Right? To looking around and saying, man, if I went into a hard situation, I could pull money from here. I could pull money from here. I've got access here, here, and here. And that creates financial stability and financial peace of mind to have that. With that said, there's a fair amount of discipline that it takes to maintain that, because sometimes people think an emergency fund is an emergency vacation fund, right? Like, I need a vacation, and next thing you know,
100%,
or an emergency toy fund, right?
Yeah.
And we just have to, although textbook,
I had to buy that Harley. It was an emergency. Yeah.
You would be surprised, right?
Yeah.
How often we hear just that, right? I'm living life to make memories, right?
Right.
I don't need and so with that said, it's also good to have sometimes a little bit of financial push, a little bit of financial pressure to help us make the right decisions. And so, if you're one of those people that will never have an emergency fund, because anytime money gets built up, you're looking at where to spend it next, whether that's consciously or subconsciously, it happens. Then we need to work around that and figure out the best way to build wealth and build assets for you, even if you refuse to have an emergency fund. Now, that doesn't mean I'm not recommending just go without an emergency fund. I'm just saying sometimes people it's too hard to have money that readily accessible. So maybe we need to create a firewall. Maybe we need to pull an investment account that's a little bit safer that we could draw on. Maybe we need to pay down, all lines of credit if we can do that without putting them back, so that we could have somewhere to draw on if we had an emergency. And so, textbook obviously is have an emergency fund, build that up, then pay down, debt. But sometimes that just doesn't work.
Okay. Well, the last one here of the most debated financial topics is a 15 versus a 30-year mortgage. And initially it surprised me when you both said 30-year mortgage, but I'm assuming you're leaning on leverage here, Rex.
I'm leaning on leverage, and so I'm doing a 30-year mortgage, which typically has a lower interest rate. Not always. Sometimes it's the same, or generally it's comparable. And so what I want the flexibility. I'm still going to pay it off over 15 years, but I want the flexibility that if something happens in life, that I can fall back onto that 30-year payment if I have to for cash flow purposes.
Okay.
And so I almost always will do the 30-year, but then I will term it out on my payment based off a 15-year or a 10-year or some shorter time period.
What about just doing what about 10 versus a 30?
Same thing. Normally it would have to be a fairly significant interest rate difference, and I would have to have extremely strong excess cash flow in order to be comfortable tying it down to that short of a time period. If a 10-year mortgage, if that payment is only 15% of my cash flow, then I'm probably okay doing that because that's a fairly small amount. But if it's, if that 10-year payment all of a sudden comes up to 30% of my cash flow and life happens, all of a sudden something happens, then it's going to be really difficult to maintain that payment. And so I'd rather have the 30-year mandatory payment and again, pay it off over 10.
Yeah, usually the shorter the term, the less that interest rate is, but kind of similar to what Rex was saying, right? Like it's so close, right? Mm-hmm. It's so close, relatively speaking, when you look at like all the numbers. It's amazing how little of a discount you get for a 10 or a 15-year mortgage. We see all the time people that have like run the numbers like, if you do a 30-year mortgage versus a 15-year mortgage, look how much more interest you pay. And those are true numbers. But what they don't take into account is, well, what if you took the difference in payment, invested it, and got an 8%? Like, look how much more money you end up with this way, right? And so I think especially coming off of the time we have with such low interest rates, where most people have a mortgage locked in at a fixed rate mortgage at 3% or less, or 3.5% or less. Yeah. That man, it's hard.
Seems crazy right now, but
it is, and it's hard to argue that it would have been wiser to do a 15-year mortgage when we can borrow money for so cheap, right? And like Greg said, if you want to pay it off sooner, you still can, right? You can put more payments toward it, or you can pay it off in full. Now with interest rates having come up so much and mortgages coming up, with the real estate market still staying fairly stable, to afford a house, it's hard to do a 15-year mortgage, right? Unless you've paid off a substantial amount. And so a lot of times that extra flexibility makes sense, unless, like Rex said, you can more than afford the payment. Maybe you're really close to retirement. You're 10 years off of retirement. You're like, hey, I'm going to have this paid off no matter what. Then it makes sense, right? Let's take the lower interest rate and kind of force ourselves to pay it off faster.
Okay.
The difference, right? Just really quick on that. The difference on that, let's say that the interest rate difference is 6% on a 30-year versus 5% on a 15-year. Just for the sake of argument, you're talking about, on a $500,000 mortgage, a $500,000 mortgage, you're talking $5,000 a year. And so you are talking potentially $50,000 over a decade of difference over 10 years. And so the question becomes, is it worth $5,000 more in interest for extreme flexibility if you have to go from a $5,000 a month payment versus maybe a $3,000 a month payment or a $2,500 a month payment if you spread that from 15 to 30 years. And so there's a cost, there's a give and take there between cost and flexibility. And generally speaking, I go for the flexibility because I've seen how often life happens to people and throws them off the planned trajectory onto some sort of alternative trajectory. And so generally speaking, it's worth that amount of money to have that kind of flexibility. If the gap is wide, then it's not going to be worth it. Then you're just going to do the 15-year or the 10-year or some, whatever time period you can reasonably afford without putting yourself house poor.
Okay. All right. Well, these were the most debated financial topics according to one person on the internet. So, Rex and Brandon, what is there a financial topic you guys disagree about often in the office that we didn't cover here?
That's a great question. We're fairly well aligned on most of our opinions. So I think
what about customers too, that like, maybe it's probably related to one of these that we've already listed, but what do you hear out there in the field maybe?
Brandyn, does anything come to mind for you? I hear a lot of, do I pay down my debt or do I invest? But the most common one I hear is the term and permanent insurance is probably what I hear the most of.
Yeah. You get the occasional 401k is a bad idea guy, right? That's like, I watched a video and 401ks are a terrible idea because you're going to pay all sorts of taxes, and that one's funny because the irony of it is 401ks, IRAs, qualified plans by definition are giving you a better tax treatment than if you weren't using those in the first place.
And they make it automatic.
Yeah. But what happens is people just focus on the back end, like, wait a minute, I have all this money, I have to pay taxes on it now. It's like, well, yeah, but you got a massive tax deduction literally your whole life, right? And if we were efficient with that at all, I mean, that added up to really build up some extra savings for you, if you're really planning with that, right? Or you do the opposite, you do a Roth, right? And we didn't take a tax deduction, but now it's all tax free. Now you've got $1 million account that is generating, huge amounts of dividends and interest, and you pay $0 of taxes on it, right? Qualified plans can be some of the most tax beneficial plans out there, and yet you get people that focus in on one side of it because they miss the other side, and they're like, this is ridiculous. I have to pay all this tax. Like, well, yeah. Anyway,
okay, Rex, anything else?
No, I think that if you're debating between any of these items or other items, then I think you give us a call. Yeah, let us talk you through and see what the depends is.
Planwithbaxter.com. Brandyn, Rex, thanks so much for being here on this podcast. I do appreciate it. If you did find value in this podcast, you can consider supporting us at buymeacoffee.com/BanyanMedia and just give us all your money. It's the best investment you could make. So buymeacoffee.com/BanyanMedia. That's me saying that, not Rex and Brandyn, by the way. You can watch us on YouTube at Through the Pines or on Facebook at Pines Podcast, and also follow us on Instagram at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.
Thanks for the clarification.
Yeah.